Hi, welcome to Mark in a Minute. This is where we look for opportunities, but most importantly, protecting the downside when we think we need to. That it describes my philosophy of loss averse investing. You got to get there relatively early in these nice opportunities. And then when the market rolls over on you, when it does, protect your profits. So protect the downside. We think the blue chips are set up really well, and we're very active in that area right now. We think the small caps are very attractive as well. We've got nice exposure there. I think the biotechs are going to be really strong in the coming, 6 months, a year from now. They're going to be up considerably, in our opinion. We think the Fed's going to give us a wink on Wednesday that they're going to cut rates. So the stock market, it's in the early stages of broadening out. And as you know, we've been looking for this rotation. We've been talking about it for three or 4 weeks now. It's starting to become a little bit of a consensus view that the small cap stocks are undervalued, but there's so much money to come into this sector. It could have a very massive move over time. We think that the small cap stocks perform best coming out of a recession, so their early cycle. And we're not coming out of a recession. We might be going into a recession or a soft landing, so it's a little bit tricky. However, the market still wants to go up, and they're looking for stocks to buy, and this is one sector that really stands out as being undervalued. So if we do get that soft landing, then this group could really run. The blue chip stocks are very undervalued versus the overall stock market. There's some great opportunities, some quality, brand name companies that are selling like they're value stocks. And then when they're reporting earnings, the stocks are popping very nicely. So 3M reported this last week, had a very big move. As you know, we've liked Raytheon for a while. It's had a really, really good move as well. And so we have a handful of those names. I'll talk about a couple of them. So the S&P has dropped 5% from its high. It's down roughly 3.5% from its high currently, but dropped 5%. So it's a little bit of a correction or a little bit of a downdraft that has occurred. And we think in the short term it's oversold, so it could bounce back. In the intermediate term, it might be overbought, and the trend might be down for the next couple of months. So it's a little bit tricky environment. AMD, Microsoft reports on Tuesday. We think AMD is kind of interesting. If they have good numbers, give a good outlook, we think there's a big rally in AMD. Microsoft, Meta reports on Wednesday. Amazon and Apple report on Thursday. They're kind of all in the same basket as Google. I think those earnings reports have to be perfect, otherwise the stocks aren't going to work. And I think the market's kind of prepared for kind of a little bit of a disappointment here and there. But I think if it's not if it's not really good, then these stocks are going to sell off. So what happened with Google is a little bit disappointing on YouTube. Okay, not a big deal, but also they upped their capital spending. That just tells you what's happening in the space. That everybody's rushing to AI to build out the infrastructure, and I think they're overspending personally, but that's their choice. So that should be good for AMD. Fed meeting on Wednesday. Look for a nice swing from the Fed. I think they will indicate that in some manner they're going to cut rates in September. I would think that I probably will see about 4 cuts over the next 6 months. So geopolitical risks are very high. I can't believe really what's happening with Russia and then the Chinese bomber off the coast. Both countries having their bombers off the coast of Alaska, and us having to patrol them away. What the heck is going on there? Which doesn't make me feel really bullish about matters. But anyhow, that's a little bit disturbing. Hezbollah bombing Israel, that's another problem. Okay, so Israel's going to have to react to it. That may escalate. I don't like the geopolitical risk profile currently. Okay, so we've talked about this before, about the earnings yield of the S&P 500, which is just the earnings divided by the price of the S&P 500, or it's the inverse of the PE multiple, right? So the PE multiple of the S&P 500 is roughly 23 times earnings currently, and that gets us somewhere around a 4.4% earnings yield. If you look at the Russell 2000, okay, so everybody says, well, there's stocks that don't earn money, and the Russell 2000 is not a quality index. That's just a bunch of BS. There's a bunch of biotechnology stocks in there. They don't do anything off of earnings. They're all development, mostly development. And so you got to throw that out and look at the median PE multiple for those stocks in the S&P 500. If you do the inverse of that PE multiple, you get about an 8.5% earnings yield. So you can see how much undervalued these stocks are versus the S&P 500. So we think the S&P 500 being about 20% overvalued. The Russell 2000 with that umbrella there of that valuation, it's 50 to 100% undervalued versus the S&P 500. So we think the rotation makes sense and it's going to last for a while. Blue chip stocks generally are trading at a nice discount to the overall market. They're not trading as growth or growth in income stocks. They're trading as value stocks. So we think those companies have about 25% upside. We showed you this graph last week, and I just think it's really good. I want to just illustrate what's going on here again. The Russell 2000 looking for 36% earnings growth next year. The Russell 1000 growth, nice growth. Russell 1000 value, nice growth. S&P 500, it's okay. It's better than what it was this year in terms of its earnings expectations. And the equal weight is coming along as well, up from 5% to 12% next year. And then the Magnificent Seven, big deceleration, 46% down to 20. These may be off a little bit here or there. If we go into recession, they may be off quite a bit. But I just want to point out, on a intermediate term basis, the growth is better as you go down in market cap. So you look at the smaller companies, the growth is really picking up, and the mega cap stocks are decelerating. Still good growth, but the earnings is decelerating. So that implies a lower PE multiple for those stocks. Blue chips, we think the market's definitely becoming aware of it. We think that in general what's been going on is the hedge funds are long the mega cap companies, technology companies, and they're short kind of everything else, especially the smaller names. So as these companies report good numbers, you're seeing a pretty significant rally in their stocks. So as you can see, J&J, rallied very nicely from the mid $140 level up to $160. It's still cheap. It's 15 times earnings. J&J shedded its slow growth consumer business, and now it's drugs and medical devices. Both those areas command nice multiples and grow much faster than the overall economy over time, especially the medical devices. They made a nice acquisition there, by the way. Baxter's doing something very similar to J&J. They're shedding their slow growth, their dialysis business. That's held its support level here very nicely. It's broken that downtrend line. It's only 11 times earnings. So this is a company that used to trade at 20 times earnings. We think there's nice upside in Baxter. Raytheon, I just want to just show you kind of, just prove a point to you that these stocks are starting to move. Raytheon, a really high quality company, stubbed their toe a little bit on the commercial business, and you can see it's popped above that 20-day, the 20-day, above the 50-day, above the 100-day, above the 200-day. As you know, we like to move in increments, but we bought this very nicely. But as stocks break through, or the markets itself breaks through these moving averages that are set up this way, to us it's really bullish. And this has moved up really nicely from the low 70s up to $114 a share now. That's beautiful in a high quality, low risk type of company. 3M has done the same thing. So it's breaking above all those moving averages and really popped in a huge way on its earnings. Surprised everybody. We want to own more 3M if it pulls back. We took a little profit in Raytheon as evaluations got a little stretched here, but we still kept a position. So we think Baxter looks really good. There's a number of really interesting blue chip stocks that we think can move on their earnings reports, and they're all coming up in the next couple weeks. So the technicals of the market, it's hit a high, down from the high of roughly 5%. It blew right through the 20-day. It went through the 50-day. Okay, remember we like moving in increments, so the kind of dimmer switch. We've gotten more defensive on the way down, and then it's right at this downtrend line. It needs to kind of break through here. So we generally like to buy indexes like this that are in an uptrend when they break the 50-day moving average. So we're kind of watching this closely. Maybe we'll take some of our hedges down if this occurs. So we think the next really good support, though, is around this 5,200 level, which is down about 4.5%. On an intermediate term basis, it's still overbought. You can see the distance it's above the 200-day moving average is pretty significant still. Now the Federal Reserve meeting on Wednesday. So this is important. We need the Fed to start cutting rates. The inflation rates running now around the mid 2% level. The Fed's target's 2%. Stated publicly, we think that that's kind of BS. We think the real target is about 2.5 to 3%. So they're hitting their target currently. You can see the correlation between the yield of the 2-year Treasury, which is the blue line, and the Fed funds rate. So there's a high correlation between these two. And you can see the blue line, the 2-year Treasury, has peaked, started to roll over. So it's down about a full percent below the Fed funds rate. So that implies a full percent cut in the Fed funds rate over the next 6 to 12 months. So if rates keep moving lower, we think the Federal Reserve will follow it down. We kind of like the Federal Reserve at times to be proactive, but in this case, tempering those inflation expectations is good, and moving down, with the overall markets is good. However, we run the risk of going into having some negative GDP numbers. So just keep that in mind. Again, we like the opportunities, especially right now, as a lower risk play into blue chip companies. We see, some good opportunities in the income area as well, getting roughly 8% yields or higher. Some of the mortgage REITs, the agency mortgage REITs we like a lot. So we see opportunities in the yield area as rates come down as well. And then our favorite area is small cap, is the biotech sector, but there's a lot of really interesting small cap companies as well. So if you're a good stock picker in small cap, this is going to be a lot of fun, and we love to pick stocks. So thank you very much. If you have any questions, just let me know. Come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute. Subscribe to the channel because it's more reliable than the email. And then please hit like, and we'll talk to you next week. We're going to talk next week. This is going to be a lot of fun. Next week, we're going to talk about our white paper on the use of inverse ETF and leverage ETFs. If you're a financial advisor, you'll find this really interesting. And then our best ideas in the small cap biotechnology space. We think Grail is really interesting, okay? Really interesting stock there. Grail sells at $500 million market cap. They got $1 billion in cash. Illumina bought them for $8 billion. So $500 million currently, $8 billion what was paid for it. May not go back to $8 billion, but there's a reason why they paid $8 billion. We really think this stock's interesting, and we've got some more to talk about. Take care.